All right, welcome. Thank you guys for attending today's webinar, Bank on Your Syndication. This is geared for those who are involved as a general partner in syndicator or about to be or have been even. And we hope you guys will really benefit from this. So yeah, we always talk about just what we do and how we can change the way we think about our finances. How do we change the way we think about our finances and see a different perspective on how to approach things. So we'll kind of dive into that today. I'm excited to talk about this today. I want you to think about something first. And I love showing this to everybody because it's just to get the wheels turning. Like, what prompts us to change? We talk about changing the way we think about our finances, but what prompts us to change? I love this quote by John Maxwell. He says, people change in 4 different seasons. He says, when they hurt enough that they have to, and when they see enough that they're inspired to, and when they learn enough that they want to, and then when they receive enough that they're able to. So I just love that quote because it got me thinking the first time I ever saw it. I'm like, it's so true, just the different ways that we change. And so today we're just going to push you to really change the way you think about your finances, change the way the money flows, and see what that'll do. You may find by the end of the day, you're going to say, hey, gosh, I need to be doing this one day. And I encourage you as well. We hear that all the time. Well, I'm going to do this one day. Let's make today day one and get around to it. But let's dive in. I'm going to kick this over to Ryan, let you introduce yourself, and we'll go from there.
Yeah, it's nice to be here with you guys. My name is Ryan Haley. I work with Jason Powers at Unbridled Wealth. And separate, but in addition to that, I'm also a certified financial planner and investment advisor at a registered investment advisor firm specializing in alternatives like real estate, private equity, private placements, and kind of outside the box, unconventional creative solutions. And certainly I would say chief among them is the infinite banking concept, which we will define in great deal as we go on. But I would say the most important thing by far for anybody listening to this is, first and foremost, I'm a real estate investor, a business owner, and a practitioner and policyholder of, someone who has done this in my own life and really had to dig in deep and learn about this. And once I did, I just kept peeling the onion and it got more and more fascinating and amazing. And I just couldn't help but share it with people to the point where now I do this as my full-time day job, if you will. But that's, I think, the most important thing. And I know Jason's going to say that as well, that we are people who are only doing this as professionals because we first done it as practitioners. So I've got an MBA and a bunch of other, educational background stuff that has given me a great kind of platform, but it was really when I combined real life experience, kind of going back to what Jason was just saying about, you can sit there and learn and learn and learn. That's good, but there's a point where it becomes counterproductive. So hopefully this is the non-counterproductive learning you're getting now, but we also hope that you take action on this. And once I did, when it came to real estate investing, when it came to the infinite banking concept and a bunch of other things, it was the really powerful combination was seeing how it all came together from the knowledge, education, and the theory side of things. And then in real life, seeing how that came together and the most importantly, the positive impact that it's had. So, there's a lot more I could say, but I think I'll just keep it short and sweet and just say that it's a pleasure to be sharing with you guys.
Yeah, that's great, Ryan. My name is Jason Powers. I am a wealth strategist, authorized IBC practitioner, infinite banking concept practitioner. I love what I do. I love getting to go around the country and teach real estate investors about the infinite banking concept. I got into real estate investing myself back in around 2008, 9, 10 when the market crashed. I was watching friends and family lose their homes, and that was frustrating. I was like, surely there's a way to not lose their homes. There's got to be something out there, some options for them. And that's kind of what got me interested in real estate investing and how to help distressed homeowners. And so I got into wholesaling. I got into fix and flips a little bit after that, a couple years later. And then I got into, start buying some rental properties and got into the short-term rental space for a while and still there a little bit. And over time, that just evolved like things do. And and ended up, several years ago, bought a 170 acre former camping and recreation area that had been shut down, and start redeveloping that, got that back open, and since seller financed that off to new guys who can carry the torch further than I can right now. But anyway, so I've had my share of real estate investing, and preceding that, right around the same time I got into it, maybe a little bit after, I first heard about this infinite banking concept, and I was like, oh my gosh, everybody needs to know about this, so I was utilizing infinite banking in my day-to-day life and my real estate investing and things like that as I went on. And then there came a time where I wanted to just make this my practice, make this what I do, and go around and teach people about infinite banking. So I made that shift, and that's been one of my primary goals, given my real estate background, is to teach real estate investors. So I hope you'll enjoy this particular aspect of it today in this webinar and what we're going to be talking about. So let's dive in. There's this need for generational thinking. Okay, we as a society really have overall, we've lost that perspective, that need for generational thinking. I think that needs to be brought back to the forefront for so many families, and from a legacy component, but just thinking beyond ourselves today. Even there's also a need for, just life insurance, downside protection, especially in real estate and what we do. It's an essential tool. It ensures our children and our dependents, can maintain living standards and things like this. So, but there's also a need for, we call it disability income protection, and that is just providing this financial security to you in the event of unexpected disability and so forth. But there's also, in all of this, there's this need for controlling the banking function in our lives. And this is what we're gonna talk about most of the time, is just how do we control the banking function in our life? Okay, so before we dive into the details, always got to give the disclaimer. Hey, we are going to give you the best advice we know how, and that we believe to be right and true, but always encourage you to seek your own tax and legal advice, and just double check it with your accountant, with your attorney, for certain things before you execute. But we're going to give you everything kosher, and you'll be fine. So let's dive in. This need for life insurance. Ryan, I'm going to kick it over to you.
Yeah. So I think most people are familiar with the basic premise of life insurance, that you get that downside protection in the case of premature death. So if a breadwinner passes away, then the dependents or people who are going to need that income can continue to have that ability to have liquidity and cash flow needs met in the event of a premature death. And I should mention here also that the primary purpose of life insurance is for death benefit protection. All other benefits are purely ancillary. However, we will find out that these ancillary benefits are pretty significant, which is going to be the thrust of our presentation. But so again, we've got this basic idea of death benefit, and that can be accomplished with a number of different types of policies: a term policy, a permanent policy, all the different flavors of that there are. So just talking about this downside risk mitigation, as a general partner or any business owner, key person protection is really important, right? So if somebody, again, kind of the same idea we just shared that was more in the personal context on the previous slide, this is that key person whose untimely premature death would cause the business to suffer, ongoing success or profitability. And particularly for anybody who's raising capital, then you probably should be thinking about this from the LP's perspective as well, because I know myself as a limited partner, passive investor, that is a question that I ask a lot, because we know that that's really important. So that's just an important thing to keep in mind, even from your positioning as a GP, that's important to LPs. Now you've also got the buy sell, and hopefully you've got that in a written, well-constructed legal document. But beyond that, you also need a funding vehicle for the buy sell, and insurance can be a fantastic vehicle to fund the buyout of a partner. And again, the case of a premature death, a disability, so you don't become de facto partners with a wife or a kid or somebody that you didn't intend to be in business with. Now, the one we're going to focus on for the purpose of the examples we'll go through today is insurance that can pay off debts, particularly in this case, large scale commercial real estate debts. And that's really obviously important for capital intensive businesses that rely on so much debt like real estate. So that's going to be the kind of assumption we're going to use for the underwriting example here. But then beyond that, we're not going to get too much into the weeds on the rest of this. There's also a really cool way you can structure deferred compensation and executive benefits with life insurance, and then also possibly stock redemption plans in the case of a corporation. Now, the other thing is for GPs and syndicators, you should really be thinking about this downside protection. If you want to hit the next slide there, Jason. Again, like I just talked about, protecting against the premature death or disability of a GP, and it can be a differentiator that can help you to differentiate your business model and also give you, a heightened sense of professionalism. And like I said before, that will help with enhanced capital raising capabilities, kind of maybe even as a tiebreaker. If an LP is looking at similar projects, one of them has this key person or, life insurance protection, the other doesn't, then that could be an important thing. And then also, if you're using cash value life insurance, then this becomes a balance sheet asset, which can be important. Now, again, for LPs or passive investors, which if you're a savvy GP, you should be thinking from their perspective, is the big downside risk mitigation benefit of insurance is being able to protect their investment principal, particularly because, as most people in this game know, in the real estate private equity space, the jockey, so to speak, is almost more important than the horse. And by that, I mean that you could have a great property, a great business model, and if the key person who's executing on that or key members of a team are no longer able to do so, then having a passive, capital investment into some of these things may not be worth anything to people who don't know how to continue to execute on that business plan. So it gives the limited partners or the passive investors peace of mind and what we call the SWAN test, the sleep well at night test. And, hopefully everybody's in the business of engineering win-wins. I know that's what Jason and I do. So those are just some important initial thoughts that a lot of people haven't necessarily thought about. And again, you can get this in through a variety of different policy types, term, cash value. We're going to focus mainly on cash value in the later parts, but whether or not it's infinite banking, so to speak, I think this is something that more and more people should be focused on in the particularly real estate syndication space.
Yeah, I agree. I think I think so. So as you listen through this webinar, we're kind of take you on a ride. We're kind of setting the stage a little bit. There's not a good, it's not a good idea, I should say, to just dive into numbers. A lot of want to just skip all the foundational stuff and then just dive into some numbers. And we don't like approaching it that way. So that's why we're gonna, spend a little bit of time here and just kind of setting the stage, building a foundation for why are we even talking about the numbers, and so lots of reasons. So Ryan's kind of dived into the life insurance space specifically and the different aspects of life insurance. But we also have this, as we've alluded to already, this need for controlling the banking function in our life. Now, Nelson Nash, which I'll talk about a few times today, he says, if some authoritative power distributed all the money in the world equally among all the people in the world, within 10 years' time, 97% of the money will be back under control of 3% of the people. Well, why is that? Well, it's because they understand money and how to get it to flow to and towards them instead of away from them. And that's what we need to do. I mean, in real estate investing, in theory, if you're a successful real estate investor and get passive income, you've started to figure that out, right? And you've started to figure out, how do we get money coming towards us instead of just away from us? I meet people all the time, every single week, when we sit down and look at numbers with them. They don't realize their negative cash flow in certain ways, and they find out through this discovery we do with them, and through financial education and unpacking just how much money is flowing away from them, and we kind of are able to turn that around a little bit. So we're talking about money a lot. Just another food for thought is when it comes to your money, what would you like to do with it? How much would you like to have? When do you want it? Think about these things. But more importantly, I think the question is why? Why are we trying to accomplish this? Why do you want money? Yes, you want passive income. Well, why do you want passive income? Well, so I can retire. Why do you want to retire so fast? So I can go, live on a beach and sip Mai Tais and okay, fine. Just have your why. So I can support my family better, so I can, live a better life, a more free, these kinds of things. And I think that's important for people before you even get into like, oh, let's make all this money and make all this money. And tonight's not about making all this money. It's about turbocharging your existing strategies and making this vehicle that will set you up very well in the next generation to come. So anyway, think about this as we dive into this. Why am I trying to do what I'm doing? So what's your why? So we're going to talk about a couple human behaviors real quick. Parkinson's law. This has three components. Okay, the first one is work expands to meet the time envelope allowed. What do I mean by that? So let's use a contractor example. Let's say you've got an apartment building and you hire a contractor to do a remodel on a bathroom. And it takes him a week to do that remodel. Great. And then you got to move on to the next one. You're like, kind of, this isn't going to be rented out for another month and a half. And so you have a month to do it. But we already know you could do it in a week. So then you let him to work. How long is he going to take to do it? You just give him a month to do it. He's going to take a month to do it. He's not going to do it in 5 days like he did it before. So it just happens, right? We're human nature. I think it's just work expands to meet the time envelope allowed. Second piece of it is a luxury once enjoyed becomes a necessity. I had a great conversation. Came up with a friend a few weeks ago, and she was talking about it was blizzarding outside, and she was talking about she did the remote start on her car. She's like, I love this remote start. So I can heat up my car. She's like, I will never buy another car without remote start. And so that's a luxury now that she's enjoyed, that now it's a necessity. And so think about it. I mean, air conditioning in your house or air conditioning in your car, just all these luxuries that you build up throughout life. And you're like, these are now a necessity. Third part is expenses rise equal to income. So as your income rises, then you change your lifestyle and your expenses rise. And so the combination of these three really is Parkinson's law. And the idea behind this is getting ahead. If you can overcome this Parkinson's law, it's almost a daily struggle. We want to spend all our money, use all the time we have available rather than just get it done and just have all these extra luxuries that maybe we don't need right now. It's not a not ever type of thing. It's a maybe not now type of thing. So to overcome that daily, if you can't overcome it, like Nelson Nash says, you'll become a slave. But the good news is, if you can win Parkinson's law, you will win. Okay, who's really in control of our money? We finance everything we do in life. Credit cards, houses, you get it, cars, everything we do in life gets financed. Who controls that money? The banking system. And what if you could have your own privatized banking system and build that up throughout your life, even set up the next generation for it? What would that change? How would that change? What if you could loan yourself the money instead of having to go get loans? How would that change your lifestyle? How would that change the people around you's life? But learning to control your money is the most profitable thing you can do in a lifetime, okay? Second human behavior I want to talk about real quick, Willie Sutton's law. He was a famous bank robber. He got caught. He was interviewed by this reporter one time, and he's like, so why do you continue to rob banks? He kind of joked, and he said, well, that's where they keep the money. And so the rule is basically wherever wealth is accumulated, someone will try to steal it. And my friends, if you are building up wealth, you know exactly what I mean. And I don't want to get political today, but biggest thief in this country, they're after our money all the time. The more money you make, the more money they're after. And how do we curb that? How do we curb that or hedge against that? Or how do we protect ourselves from that or benefit? We like tax deferred. We like, tax free, obviously, but tax deferred approach in many things is our preferred approach because it's deferred down the line. But when I ask people, hey, would you rather pay taxes now or later? Initial response, most people later. Okay. Well, you think taxes are going up or down in your lifetime? Initial response for most people, well, growing up. And I say, well, if you think taxes are going up in your lifetime, why do you want to constantly put your money in something that's going to pay tax at a future unknown rate? Why would you do that to yourself if you believe taxes are going to go up? So just food for thought. So enter the infinite banking concept. If you've never read this book, pick it up. We'll give you a link at the end for a place you can buy it. You can get it from their website as well, the infinitebanking.org website. And it's a great book, 92 pages. This is really the Bible of infinite banking, okay? It is the core of where this idea came from. Nash put words to it a long time ago. And I joke, but it's kind of true. Like second to the Bible, this book changed my life the most. And it's just such a good book that talks about why do we want to control the banking function in our life? Why do we care? IBC is it's not some financial hack. It's not some gimmick. It's not some, something that only a few can do, and there's not a one size fits all approach. It's about taking control of the banking function in your life. So this is the concept that we are talking about, and then Ryan's going to share with us the implementation of that concept and how that can work. Okay. So the infinite banking concept is the best place to warehouse your wealth. It has guarantees, safety, provides ready access to your money, and of course, if I said it 300 times already, takes control of the banking function in your life. 5 rules of IBC, and then we're going to get into what is it, how does it work. Okay. Take the long view. What do I mean by that? Real estate investors, we are a conundrum. I talk to real estate investors all day, every day, and we're a conundrum. We have the ability to think long range, but we are also some of the most impatient people I know. We can think long range when it comes to building up passive income. We buy rental property. We're looking down the road. We're thinking, okay, what can we do with this down the road? What is this doing for me later? Yes, a little bit today, but we're building up for passive income, right? So we have the ability to think long range, to take the long view, but we also, some of the most impatient people, we want that deal done yesterday, a week ago. We want that process done now. We want it done now, right? And so as we talk through this today, take the long view, okay? And then when it comes to infinite banking, take the long view, okay? It's not a get rich quick approach. It is a steady, consistent, reliable, guaranteed approach. Don't be afraid to capitalize. Once you understand IBC and how it works and truly get your head wrapped around it, you will not be afraid to capitalize. You will constantly be saying, well, how much more can I put into this system? Don't steal the peas. That's a reference from the book, which we'll talk about again, but it means be an honest banker. You wouldn't steal money from the bank, so don't steal money from yourself. If you're going to borrow against yourself, pay yourself back. Have a plan to pay yourself back at some point by some means. So don't steal the peas. Don't do business with banks. If you have the ability to be your own bank, fund your own deals, don't do business with banks. Rethink your thinking. Okay, this is not a common approach. We don't joke. We talk about as authorized practitioners. I talk about with others that we want to build up the 10%. What do we mean by that? We want to build up, get 10% of the population to know about IBC and understand it, and then that's going to catch, and then everybody, it'll just catapult from there. And you're starting to see it. If you're on social media, you're starting to see it a little bit more and more and more over the past few years. We've noticed it, even just bouncing around. All right. So what is it? The vehicle through which we implement the infinite banking concept is properly structured dividend paying whole life insurance from a mutual carrier. And Ryan, I'm going to kick it over to you.
Yeah, all those points are very critical. It's the structure to do this right, especially if you're doing, large scale real estate or business and investments where you're getting a much higher rate of return. You want to have as much liquidity available as soon as possible, right? So your typical granddaddy's whole life policy, if you will, is what we call base only. It's going to take a very, very long time for the amount of money you put in to equal the amount of cash value that you're able to use, sometimes decades. But if we structure this correctly, using the majority of the premium being allocated to what we call the paid up additions or PUAs, that is the cash value supercharger, if you will. And by the way, that also drastically reduces the agent's commission. So a lot of agents either don't know how to structure this correctly, or they do and they don't want to because it's going to have a huge effect on their commission. What we do all day, every day, is try to cut our own commission to the bone, lowering the cost of insurance and our commission so that you can have a well-structured policy to do exactly everything we've been talking about. Now, also having a whole life policy from a well-established, highly rated, solvent, and conservative mutual carrier that pays dividends, it's called a participating policy, is also very important. You probably don't want to do this with the stock company. And I try to avoid, all or never statements, but that one's a pretty big deal. So, again, when we're talking about this stuff, this is a product that's been around for hundreds of years, as Jason's going to talk about later. But the way that we're structuring the policy, and also importantly, how we're using it in an integrated strategy and comprehensive plan to accomplish the specific goals and objectives in mind for that particular client, is really, really important. So just if you do research on this, you're going to hear opinions all over the spectrum, and it's really, really important. If you don't do this right, just like with real estate, if you don't know what you're doing, then you can get yourself in trouble, right? So just like anything, I can tell you that I've both made and lost more money in real estate than almost anything else. And the difference was being knowledgeable, educated, having a good team around me. So just can't emphasize that enough.
Yeah, and just to clarify, the mutual carrier, dividend paying mutual carrier thing, to restate, there's two types of insurance carriers. There's stock owned companies, it's interest for the stockholders, and there's mutual carriers, where basically as a policyholder, you're effectively one of the owners of the company, thus entitled to the profits, which come in the form of dividends. So that's why we say dividend paying from a mutual carrier. And in the context of infinite banking, we are talking about strictly whole life insurance. There's a half a dozen, types of insurance out there you can get. For today's conversation, we're strictly talking about whole life insurance. We're not talking about term, obviously, or universal life or anything like this for today's conversation. Whole life, been around a very long time. This is nothing new. How you structure it is what's changed. Okay, as Brian talked about. It's been around since the 1700s. I love this. It started out as a corporation for relief of poor and distressed widows and children of Presbyterian ministers, which is a mouthful. But that's actually the shortened version. It started because ministers were being supported by the church, and upon their passing, they were no longer supported by the church. Thus, the family was all of a sudden left destitute with no income. And so this idea got started, like, how can we help the families out beyond this person's death, because they spent a lifetime in ministry, and now all of a sudden they're not getting paid. So that's how it got started. Who carries cash value whole life insurance? Banks. We've already talked about banks. Banks carry billions of dollars in cash value whole life insurance. You can find it on their balance sheets. It's a tier 1 asset. Find it. Go find their annual reports. You can find it in there. Some of these banks on the screen own more in cash value whole life insurance than they do in real estate. And think about that. It's a massive number. Big companies, they have utilized it, understand it. Business owners, as you start digging around, you start finding some interesting stories throughout history of people who have utilized cash value whole life insurance for certain things. Walt Disney, he couldn't get enough of a loan to fund a theme park based on a mouse in California. Anybody ever heard of it? So he borrowed from his policy and helped fund towards starting up Disneyland. Ray Kroc, when he bought out the McDonald brothers, he actually had two different policies. He used one of them to pay some key employees. He used another one to start a marketing campaign on his newest, latest, and greatest mascot, Mr. Ronald McDonald. So it's just kind of fun as you dig around and see kind of what's it been used for historically. Maybe Ronald McDonald wouldn't even be here today if he didn't have this life insurance policy. So who knows what will happen. Certain dignitaries, they understood it. What are they doing? Interesting article came out on President Biden a while back when he had to disclose his finances. Talks about how he owns 0 investment products and 6 whole life policies. I thought that was fascinating. Well, he's not broke, so what's he doing? Okay, and that's the thing. There's this wealth of knowledge out there. There's the common knowledge, the stuff we're all taught. But then there's this huge pool of uncommon knowledge, and that's what we're showing you some of today. What's this uncommon knowledge that's out there? It's out there. It's there. It's not just for the uber ultra wealthy. It's not beyond our reach. Ryan and I, we're just normal guys. We're not no Rockefellers. And we get it. We're using it, utilizing it in our life. Our generation and the next generation and the generation beyond that will benefit from it. So a couple of features as we talk through this. Think about today as we talk, we're talking about is changing the flow of your money. We're not talking about changing your real estate investment strategies. Okay, and that's important to remember. Changing the flow of your money. Okay, I think one of the single greatest benefits, which Brian will kind of talk about a little bit too, is the fact that the policy values, your cash value, will grow uninterrupted throughout your entire life, even while you're using it elsewhere. What do I mean by that? Short example, let's say you've got $100,000 sitting in a high yield savings account at 5%, and you pull 50,000 of it out. It's only growing on what you left in there, the 50,000. You understand? You've now interrupted that growth. So maybe it's compounding what you've left in there, but it's interrupted. Okay. In properly structured whole life insurance and accessed properly, you will have, if you had the 100,000 sitting in there and you borrowed against it for 50,000, it's going to grow as if the 100,000 never left. So it's growing uninterrupted, and we'll break down why that happens. But I think that's one of the single greatest benefits, just the power of uninterrupted compounding throughout a lifetime. You can address a lot of lost opportunity costs through this. I'm not going to camp here. Income tax-free growth in your policies, which we'll talk about. The gains, so to speak, inside your policy throughout your life will not be income taxable because you will always access them as loans, and the IRS does not tax on loans. Okay, it's a vehicle, which we talked about, for the uninterrupted compounding. You can use it now, but you can also use it to supplement or be your retirement later. Furthermore, income tax-free. And that's such a huge benefit. I can use it now throughout my life to make me money, save me money, and then retire on it.
Yeah, I just want to hit that point real quick, Jason, that when we talk about properly structured, that's another critical point, that it not be structured as what is called a modified endowment contract or a MEC. There's a specific portion of the Internal Revenue Code that discusses that. As long as, and we're not going to go into the specifics and the nuances of the technical details of that, but it is really important that it's funded as aggressively as possible so as not to be a modified endowment contract and therefore retain all the tax benefits. Now, if you want to, at some point later in life, you can access money in the form of withdrawals as opposed to loans, up tax-free up to basis. But anytime, like Jason said, as long as it's not a MEC, and especially if you're taking loans, that's never going to be taxable. But it is important that it's structured the right way. And that's why it's so critical to work with, a qualified professional when you're doing this.
Mm-hmm. And that's what we'll walk you through in getting your own policies and stuff, like making sure stuff like that never happens. So also, just as a point, it is life insurance. It is not an investment product. It is an asset. Okay. It is safe from investment booms and busts. It's not tied to the market, as it pertains to whole life insurance. So you don't have these ebb and flows and market fluctuations, and you can't lose your money. It is guaranteed contractual growth inside your policy. When you borrow against the policy, loans are not tied to your credit. It doesn't show up anywhere. You, me, and the insurance carrier know about it. Okay. And that's it. And whoever else you tell, right? It's an unstructured loan. How would you like to borrow and then dictate your own loan terms? How would you like to be your own bank? So you get to dictate the loan terms. Do I want to pay it back in a day, a month, a year, 10 years? Never. Okay. How often do I want to pay it back? How much am I going to pay back per month or per year? Whatever. Right? You get to dictate the loan terms. It's a multitasking dollar. It's doing multiple things at once, as we've alluded to already. Growing inside your policy, and then you got the money out, doing multiple things for you, making you money, saving you money, etc. Maybe even doing that plus helping you at retirement. All these different things it can be doing for you. And then, of course, we've got the generational wealth transfer. And so on that generational wealth transfer, it is, it's just a vehicle, because we're talking about life insurance, right? It's this vehicle through which you're going to build up throughout your entire life, use it throughout your entire life, even into retirement, but then something that can sit with you and go on to the next generation and the generation after that and after that. And that's one of my favorite parts to teach. We're not going to have time today, but just showing how you can make this truly an intergenerational product. All right.
So you guys can see the screen here, yeah?
Yep.
So we talked about some downside risk protection benefits of life insurance, which are pretty extensive. But what we're really going to focus on the most in this presentation are the upside benefits, specifically with cash value or IBC policies. So besides the death benefit, which again is tax-free, and if it's a personally owned policy, creditor protected, which is a pretty big deal, that may or may not apply for business-owned policies, depending what state you're in. But besides the death benefit, you've got this additional return component. Like Jason said, it is not a fluctuating variable market security. It's going to be very steady Eddie. You can count on it. You've got that uninterrupted compounding, which is so important, of that cash value growth. Safety and predictability, because we're taking a lot of risk outside the policies if we're doing real estate projects like we're going to talk about. It's a non-correlated or diversified asset that is funding a different asset. And then you've got this incredible tax efficiency, right? Jason talked about that. The tax deferred growth, if it's structured right, it very well could and should be tax-free throughout your whole life. And then what's amazing on top of that is that when you're borrowing from the policy, you are paying interest. And that is an expense that's out of pocket. But what's great is that if you're using it for a qualified business or investment purpose like real estate, then that interest should be tax deductible. Again, that's stuff you want to talk about with your tax professional, but those combinations of things together add up a lot more than you might think. And so, again, just to compare and contrast the typical type of policy with what we're doing with IBC policies, in a traditional policy, most people's goal is obviously to minimize the premium expense and maximize their death benefit, since that's all they're thinking about it for. It's the exact mirror opposite. We're flipping this on its head when we're talking about an IBC policy, where we want to maximize premiums and minimize death benefit. And that sounds backwards. Why would we want to do that? It's all about optimizing the cash value growth, the immediate amount of cash value you can access day one, and the growth of that cash value over time. And by minimizing the death benefit to at least meet the minimum you need, you are reducing your cost of insurance. And just like, even though this is not a securities product, similar to how a mutual fund or some kind of portfolio that you might have with traditional assets, the more expenses inside of those funds or that you're paying to brokers or whatever, the less that money is compounding. And the death benefit, while extremely valuable, is going to have an expense associated with it. So we want to drive down the death benefit and therefore the cost of insurance as low as possible to meet both the IRS guidelines and exactly what you need, but no more, in order that cash value can grow optimally. Now, what's really important about this, as well as having a well-structured policy, is the financing aspect, the banking function, like Jason talked about, where we are going to, for the most part, at least in the first, probably 10 to 20 year plus period of the policy, we're going to access cash by borrowing as opposed to withdrawing. And again, like Jason talked about, that's because when you borrow as opposed to withdraw, the entire amount that you put in is all continuously compounding and interrupted. So just this one point right here, I think, gets missed by so many people that are talking about this, even very savvy experts who do this, is that most people talk about the positive rate arbitrage, which we'll get to. But the most important thing in doing this is actually compound versus simple interest. And Albert Einstein said that compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So we want to be on the right side of that curve. And so bottom line here is we want to earn compound interest and pay simple interest. Even if you have the same or even a lower rate that you're earning, if it's compound earning, then it's going to, over time, you'd be surprised how much drastically it will overwhelm even a higher interest rate that you're paying on a simple basis. So I actually have a spreadsheet where I put that together. It's pretty fascinating, but I think that point is really, really important to understand. Then on top of that, most of the time we are going to have some kind of positive arbitrage, which means you're earning a higher rate, paying a lower rate. So for instance, if you can earn, say, 4.5% long-term and pay 3.5 or 4%, whatever it is, then you're getting a positive rate arbitrage and you're profiting from that spread. Again, though, that is not as important as the number one thing, which is compound versus simple. On top of both those things, as if that wasn't enough, you've got this tax efficiency on multiple levels, where number one, the compound earnings are not taxed if it's structured correctly, whereas the simple interest that you're paying out of pocket is tax deductible if, again, it's for a qualified investment or business purpose, which in the context of this presentation, it would be. Now, perhaps the most important thing that Jason and I probably talk about with most real estate investors all the time is they'll say, okay, this is an interesting thing. You got a new concept, a new wrinkle in my brain, but why would I settle for 4 or 5% long-term tax-free, uninterrupted? I get all that, but when I can earn 20, 25, 30+% IRR in my real estate projects, and emphatically we're saying, do not. These policies are not meant to replace the investment. They are meant to fund it. They're really meant to replace your checking or savings account as the funding vehicle or the opportunity fund. And what's so important about that is that you can then get your money working in two places at the same time, both inside the policy and inside real estate. And it could actually be multiple places, way more than two. But again, the policy is not the investment. The policy funds and protects the investment, especially if we're using it as a loan payoff or a key man or something, buy-sell agreement type policy like we talked about earlier. So before we move on, say, Jason, if you have any follow-up comments.
Yeah, as we dive into this case study Ryan's going to talk about, I want you to keep in mind, forget the number of zeros on these examples. The important thing is the concept. What is it doing? Why is it doing it? How does it work? Okay, and so we got some big number examples for GPs here, and we've got clients doing a couple $100 a month, a couple 100,000, a few 100,000 a year, a lot. And so, and everything in between. You just kind of have to understand the principle behind it and why is it doing what it's doing. So for you, if it makes sense to add 2 zeros onto this, do so in your head. If it makes sense to take 2 zeros off, do so. Principally and structurally, it's going to be all pretty scalable for the most part. Okay, so just keep that in mind as we go through it.
Yep, that's a good point. So this is I'll just give you a basic idea. This is a hypothetical scenario, but being somewhat familiar with, these real estate syndication projects, both as a potential investor, as well as a financial professional with a lot of clients who are investing in these. I'm trying to make this as representative as possible. But again, don't get hung up on these numbers if they don't quite fit or make sense in your context. We're just trying to fit a scenario that you can wrap your head around how this might actually work without getting mired in the details. But in this case, we're talking about a multifamily value-add commercial real estate project. And we're also going to assume that at the beginning, in the start or year zero, if you will, a $35 million property acquisition. Of that $35 million, $25 million of that is debt, which would be probably an interest-only bridge loan. That $25 million of debt, like we talked about earlier, is going to be the basis for the business policy underwriting to get that much death benefit, which is what would take to execute on the plan that we're going to show. In addition to that $25 million of debt, we're going to raise $15 million of equity, $14 million from the LPs and $1 million from the GPs. And of that $15 million, $10 million would go to the down payment. So that $10 million down payment plus a $25 million bridge loan is what gets you the $35 million property. And then obviously you'll see that we've got an extra $5 million, right? And so we're setting that aside. Again, this is a multifamily value add project. It's going to be capital intensive up front, making those improvements to the property. And so we're going to set aside $5 million extra beyond just the down payment and the debt to do CapEx. And of that $5 million CapEx budget, $1 million will set aside as a contingency fund, if you will. We're not planning to have to access it, but we've got it in case of emergency. And that $1 million contingency fund is the policy premium. So I know that's a lot of numbers, but just to kind of boil this down, of all these numbers here, what it comes down to is that $1 million for the contingency fund that's part of the $5 million CapEx budget, which is part of the $15 million equity raise, is what we're going to use for that initial premium that goes into the policy. And then after that, years 1 through 7, we'll assume that the property level cash flows, the NOI, net of debt service, and all that stuff is actually what's going to continue to pay the ongoing $1 million premium for those first 7 years. So again, I'm kind of making this up, but $4 million in gross receipts, figure after expenses, debt service, et cetera, you've got about $1.5 million of net cash flow. Of that $1.5 million of net cash flow at the property level, you're going to use $1 million of that to pay those annual policy premiums. So in case you're wondering where the money is coming from to fund this policy, that's really what happened. And so again, don't want you to get bogged down in these numbers, but I'm trying to paint a representative picture where you can actually see this working in real life. So now, what a lot of savvy syndicators do is halfway through the project, they'll do a cash out refinance, right? Usually because they're starting typically with interest-only bridge loans, they're going to, once they make those improvements, drive up that forced appreciation through improving NOI, increasing the revenue, decreasing the expenses, then they can drive the property value higher. And if you're buying at a higher interest rate environment like right now, you might also benefit from a tailwind of decreasing interest rates or cap rate compression. But either way, we're going to assume that you've generated significant equity in this property, that original $35 million purchase price, the property is now worth $47.5 million. So you're able to extract $12.5 million tax-free, which is another form of It's not technically infinite banking, but we're using the same concept of borrowing against a performing asset rather than liquidating it and losing access to all those benefits. Of that $12.5 million cash out refi proceeds, $10 million gets paid directly to the LPs as a return of capital. So they're almost, they got most of their money back, right? They put in $14 million. They've got $10 million from this. They've probably gotten some payouts along the way. And then that extra $2.5 million is going to repay the policy loan. And I'll go through the policy loan borrowing schedule in a second here. But that's a pretty typical deal that I see in this space. And then we'll call it end of year 7. We'll say this is a 7-year project. You've got your full cycle disposition or sale. And we'll say that property has gone up to a value of $60 million, which gives you another $12.5 million on top of what you had after the cash out refi, which gives the LPs their final distribution at the end. And then the beauty is years 8 plus is a GP. Since this policy has already been funded, you can now take policy distributions for the rest of your life well after the deal is done. Or if you wanted to, you could continue to pay that out to LPs. There's an infinite number of ways you could do this. But again, I had to choose something. So in this case, since we assumed the GPs funded the $1 million capital out of their own pocket, because hopefully as a GP, you've got some of your own skin in the game. That's definitely something as an LP I'm going to ask you. Then you've essentially funded that policy for the benefit of the LPs in the project, and now you have this ongoing revenue stream or income stream tax-free for the rest of your life. And that's going to be a pretty powerful starting point. In the beginning of year 8, you should have $5.4 million of net cash value, even after all the loans and everything, which will increase every year. So I'll show that. A picture's worth 1,000 words. I just wanted to kind of give you paint a picture of the actual project level details, and then we'll go to the IBC policy level details. But I'm going to stop and take a breather real quick and say, Jason, if you have any thoughts or comments before I proceed.
No, I think that's great. I think just again, these are good numbers to work with. I love how it's laid out, and just take the concept, and take it and go, how can I apply this in my own life and in my own situation, my own deal, and Ryan and I, that's part of our job too, is to help you strategize through those ideas.
Exactly.
And come up with it. But yeah, let's keep driving forward.
Great. So going into the policy itself now, we're going to assume there's a couple important things here that determine how the policy is going to perform. Age, gender, and health rating, chief among them, in addition to a well-structured policy design. Now, something that I didn't put in here, but that might be relevant in case you're wondering how we got such high cash value numbers right off the bat, is that we're also assuming that we have remember we talked about there's the base only premium, and then there's the paid up edition, and that paid up edition or PUA is the cash value supercharger, as we call it. In this particular example of that $1 million premium, I structured it so that $150,000 would go to the base premium and $850,000 or 85% will go towards the paid up edition. And that's, again, very favorable to the client and policyholder, much less favorable to the agent. But as Jason and I have found, you do the right thing for people, we make it up on volume and referrals. But that's an important thing to know and understand and ask your agent about very directly. We're very transparent, and we're happy to share, our compensation and how all this stuff works. So with that said, here is the actual policy details. Again, we're going to pay a $1 million annual premium for 7 years and then nothing ever again. And again, if you're wondering where that came from, just as a reminder, the first $1 million was through the equity raise, and then the last 6 years, it was through the ongoing property net cash flows. Now, I'm going to go through these policy loans here, and you'll see this, but I'm actually going to switch over to the policy itself before we get into that, just because, again, I think a picture's worth 1,000 words. Hopefully, you guys are seeing the policy here, right?
Yep, supplemental IRR.
Yep. So you can see here the $1 million initial outlay at the end of year 1. So they start at the beginning of year 1 at age 45. At the end of year 1, they'll be 46, and they should have $820,000 of cash value, which is pretty amazing to have that much immediately available to you. You can usually borrow about 95% or so of that. So let's just say that you're going to have immediate access to borrow about 800,000. That's pretty good to have immediate access day one to 80% of what you put in. And again, a lot of that has to do with how this is structured. Now you'll see also over here, the death benefit is almost $19 million. And then as you keep putting these premiums in every year, so year two, you put in $1 million, you've got accumulated outlay of $2 million in the policy, and so on and so forth. You can see how their cash value and your death benefit goes up every single year. And by the end of year 7, you'll have put in $7 million total. You'll have a little over $7 million of cash value, and you'll have over $32 million worth of death benefit. Now, here's where it gets really amazing. You see, now you could continue to pay these if you wanted to, but we just wanted to show you, something that matched up with the syndication project and did not need further funding.
And I would just reiterate, this cash surrender value is as Ryan said, 95. You can assume 95% of that cumulative value is what's accessible. So
right.
Don't think about, oh, I'm out $1 million a year. You're not out $1 million a year.
Right.
You have access. That first year, you had access to 800 of it. The second year of the 2 million total you put in, you have access to 1.7 of it, and so on and so forth. And so it's not, this, as Ryan said, is a contingency fund of sorts, but you can't access it at will.
Right, exactly. And you'll see that you are going to be slightly behind for those first 6 years, right? You've got almost as much as you've put in, but not quite, right? And that's part going back to what Jason talked about. The number one rule of IBC is you got to take a long-term perspective, right? It's not a get-rich-quick scheme. But look what happens after 20 years with less than a 4% net IRR, your $7 million outlay has almost doubled. And by the time this person is 97, let's just say they've lived to the ripe old age of 97, they're 52 years into this policy, they haven't put in a dime for 45 years at this point. And look at that. They've got over $52 million of tax-free cash value, and still that death benefit is $56 million. Now, I do want to make a point here. A lot of people get confused on this. They think that they have the cash value, and then on top of that, they also have the death benefit. The way to think about this is the cash surrender value is the portion of the death benefit that is currently available for your use, whether through a withdrawal or a loan. And obviously, we recommend taking loans so you retain that uninterrupted compounding. But that's just important to know, because you'll see that at the very end, these policies are actuarially designed at age 121. The death benefit equals the cash surrender value. And that's very much by definition, right? So that's just a little bit of, you don't need to know all these details, but we just want to share kind of how the product works, how it's designed, and so you can understand and trust these numbers better. But I mean, again, you don't need a super high rate of return to generate substantial wealth. And as we'll go into, again, adjusting for taxes, this is a lot more. If this is tax-free, if you're in the 30% tax bracket, then you can gross these numbers up by quite a bit, right? And at the same time, you're getting a tax deduction on those interest deductions. So I'm going to go back to the other tab. Actually, I'm going to go to another tab and show you what this actually looks like to borrow from the policy and what those outlays look like. So can you guys see here the policy outlay?
Yep.
Okay. So you can see here that we're going to take, even though this was a contingency fund that wasn't meant to be tapped into, we're not going to be scared to, use the access the cash value through the loans if we need to. So we'll assume that some things didn't quite go to plan, which is almost always the case if you've ever done this for any amount of time. And let's say that of that $1 million premium you put in, you're going to need to access 500,000 of that cash value. Well, no problem. You've got over 800,000 available to you. And we're going to, now, one thing that's important about this is that these policies have very low fixed guaranteed for life interest rates. And in this case, the fixed rate is 4%. Now that's pretty darn good when prime's at 8.5%. To be able to borrow guaranteed interest only, unstructured at a flat 4% is really great. So of a 500,000,
that's for the whole rest of your life. As long as you have that policy, you always have the option to borrow against the policy at 4%.
Yep, and that's a really, really important thing. You may not necessarily always want to borrow at 4%, which we'll go into why in a second. But right now, That's no problem. So if you're going to borrow $500,000 at 4%, you're going to pay $20,000 of loan interest in that first year. Second year, we're going to assume that you're going to take $1 million loan to pay for whatever it is that you needed to from the project. Again, this was really designed as a contingency fund you don't need to tap into, but we're showing that it still works great if you have to. And so at $1 million in the second year, you've got a cumulative loan balance of $1.5 million because you haven't repaid any principal in this example, which means you're going to pay at 4% $60,000 of loan interest in year two. Year three, you borrow another $1 million. So now you got a cumulative loan balance of $2.5 million. And again, at 4%, that's going to be $100,000 of interest. So in year four, remember, end of year four, this is where we assumed that you were going to have that cash out refi of 12.5 million. 10 million went to the LPs as a return of capital, which was also tax-free because it was borrowed from a loan, even though it wasn't the policy loan. It was the cash out refi loan from the property. And we're going to take the remaining 2.5 million and repay this loan here. And then we're going to switch over from a fixed loan at 4% to a variable loan at a little over 5%. In fact, it's actually 5.05%. And Jason, why would we want to switch from 4% to 5%?
There's with policy design, there's things called direct and non-direct recognition, and you can look it up. We don't have time to kind of jump into it too much today, but when you borrow again at fixed, the dividends will be affected to a point over the long run because you're borrowing at that low fixed rate, and then you have the option to do the variable loan rate, which obviously is variable, and so the variable loan rate will not affect your dividends over time. So there'll come a point in these policies, like probably on the illustration, the first 2, 3, 4 years, the dividend's really low. And so the fixed rate fine didn't, who cares about a couple dollars on the dividends. Over time, as you start stacking big dollars and keeping excessive loans out, that's going to affect the dividends pretty significantly over time. So it may be worthwhile to go to a point and a half difference on interest to get an additional 20,000 in dividend or whatever the number would be that year.
Right. Exactly. Yeah. And so here's showing you guys here, this is the annual dividend, which is designed to be very low, which looks bad, but it's actually good because the dividend is the non-guaranteed, but very consistent portion of the policy. And you can see that's negligible these first couple of years. That's why we borrowed at the fixed rate, because there wasn't much of a dividend to impact negatively. Once we get to year four and beyond, you can see how much these annual dividends are. So these dividends become much more valuable than saving a 1 or even 2% difference on the loan. It's worth it to pay more in interest if we get to retain these dividends and have them be unaffected. And you can see these dividends get, very significant in later years, over $1 million once you get into the late 80s, early 90s. So, and remember that that's all tax-free, uninterrupted compounding. Whereas if you're getting a tax deduction, maybe paying a little bit more in interest isn't the worst thing in the world because you're getting more deduction, knowing that you're also getting more tax-free growth in the policy. So that's why we switch over in this example after year 3 to the slightly higher, but still very reasonable 5.05% interest expense in this example. And then we're going to assume the same thing, another $1 million loan in year 5. And at 5.05%, that's going to be $101,000. And then, at the end of this whole thing, we're going to assume that by year 6 and 7, the property's gotten enough efficiencies and it's cash flowing enough. We don't need to borrow from the policy anymore, but we still haven't repaid anything. So all in all, you spent about $535,000 or so on tax deductible interest. And again, going back to the illustration here to show you how this breaks down, then again, we borrowed $500,000 the first year, borrowed $1 million the second year, borrowed $1 million the third year, at which point our cumulative loan balance is $2.5 million. And then we repaid the entire $2.5 million loan to pay off and extinguish the fixed loan Then we went ahead and borrowed $1 million at a variable loan. And you can see that $1 million at 5.05% was $50,500 in interest. Borrowed one last time in year 5 for $1 million for a loan, at which point the cumulative loan balance is $2 million. Again, at 5.05%, you're paying $101,000. We're not borrowing anymore, but we're not repaying anything in years 6 and 7. So that's where these numbers come from. You've borrowed, you have a cumulative loan balance at the end of year 7 of $2 million, and you've paid cumulative loan interest over those 7 years of about $535,000. Then we see this thing called RPU after year 7. What does RPU mean, Jason?
Yeah, so reduce paid up is what it stands for. Basically, in short, we're adjusting. We're saying, hey, we don't want to pay any more premiums, so adjust the death benefit down so that what I have paid pays up the policy for the rest of my life.
Yep. And so you see here, notice how that death benefit got up to $30 million at the end of year 7, and then it goes way down to $12.7 million. Well, after year 7, you've exited the project. You don't have the need for death benefit protection to protect the LPs in the project anymore, but you still have it in case you need it. But look what you also have, $5.4 million in net cash value. And what's really important about that is that we, through no external cash injection, we were actually able to pay off. Remember, we had a $2 million outstanding loan on the policy at the end of year 7. And you see that after year 7, that went down to 0. How did that happen? Well, we were able to use a permanent withdrawal within the policy of $2 million to pay off that loan, and it still left $5.4 million in there. And without putting in a single premium ever again, you see that this number keeps going up each and every year. And it's kind of powerful when you actually look at it on an annual basis. After having paid everything off after year 7, now you got $271,000 of tax-free safe growth in year 8. And you see that keeps going up and up and up. By the age of 72, this policy is kicking off over $600,000 tax-free. By the time this guy's
in 1 year,
in one single year,
and that's what you're showing is like each year, that is the growth in cash value that particular year.
Exactly.
And I think that's so exciting. Like I always get excited when I see these kinds of illustrations with these big numbers in the RPU and how you've effectively wiped out a $2 million loan without any external injection, as you put it. And you're just readjusting the structure of you're restructuring the policy at that point to take down that $2 million dollar loan you had. Now, I would say, which you may be talking about too, you could certainly, this is optional, right? We don't set it up out of the gate to RPU year 8. We decide when we're approaching year 8, do we want to RPU it? So you, as the investor, may decide, you know what, it's more advantageous for me to retain that $2 million loan, not RPU it, and then we'll pay it off a different way because my cash value would be $2 million more in here in the end.
Or you could still RPU, but rather than extinguishing the loan, you could let the loan ride, keep paying interest. But you'll see that if I were to bring up that kind of illustration, then your cash value would be growing at a much higher clip. The trade-off is that you'd be continuing to pay that interest. And that probably would be a better option in some cases, but we just wanted to show you a simple conservative example that still has very powerful, compelling numbers. Again, assuming this guy lives into his 80s, by age 86, 41 years into the policy, having not paid a single premium since year 7, look at that, over $1 million a year of tax-free growth. And you see, that death benefit keeps going up and up. So pretty powerful just by redirecting the flow of your money, like Jason talked about earlier. Look how much more wealth you've been able to create on a net basis. And particularly the tax benefits, which we haven't even modeled out the tax equivalent yield of all this, it would be significantly more than what we're showing. So if you make $100,000 tax-free, if you're in the 35% tax bracket, you would have had to have made $135,000 to equal that $100,000 tax-free. So think of what $1 million tax-free would mean at whatever tax rate you're at 40 years from now, which, as Jason said, I think is probably going up, not down. So that kind of breaks all this down, and that's just the what we already looked at, these numbers in here. But I think at this point, that's pretty much the end of the hard numbers. But I just hope that proved a powerful example that was realistic enough for you to be able to wrap your head around how that might work without getting so detailed that you're getting lost in the weeds. And so that's the end of my portion. I'll send it back to you, Jason.
I think it's such a fascinating vehicle. Like, and I never tire of it because it always pumps me up. Like every time I talk about it, I'm like, man, look at how versatile this is and how many different things this can do throughout a lifetime. If I had enough patience just to get through that first year, really, it's the first year. And then after that, it's like, what can it do for me? And even if you're watching this and you're not a GP, and you don't deal with these kinds of numbers, it still works. It still works on a small level, and you're just at different numbers, and that's why we talked about early on, like it's just a different structure. And so don't get hung up on the numbers too much. We've got people doing a couple $100,000 a year. We've got people doing a couple $100 a month. What works for you, and that's our job. Just sit with you and figure out what'll work for you and your situation, because there is no one size fits all approach. I have people all the time. We do these webinars and I teach in front of real estate investor associations, and all the time, every week I'm talking to somebody and they're like, I need to do this one day, and they're pumped up. And I said it earlier and I'll say it again, turn that one day into day one. Let's make today day one, and let's get around to it. And really do. I'm going to reiterate, change the way you think about your finances, and it will change your life. If you've never read the book, please read the book. You can grab it on my website here. I'm not here to sell you books, but you can grab it there. You can use the discount code to grab the printed copy if you'd like online. Otherwise, you can grab it directly from the infinitebanking.org website as well. And grab the book, read it. Call us next. Call us sooner than later, as we'll go through the book together with you. Do a book study together if you want. Chapter by chapter. I've done that with clients, and just really talk through it and drill down the principles of infinite banking, and then strategizing with you individually. What does it look like for you in your situation? We get all kinds of questions. We spend most of our time doing education, and then we want to do the strategy planning from there. Okay, so no strings attached. You're not locking yourself into anything by calling us. We are not salesmen. We're educators, and strategists, and we want to help you understand it and then help you implement it. And so our information is on the screen. You can reach out to us. You can grab scan that QR code. That'll take you to a landing page where you can fill out the contact form there and reach out if you'd like. We'd love to just sit down and chat, hear about you. What are you up to in your real estate, and how can we help you turbocharge those strategies and improve those strategies?
Yeah, absolutely. So you can take a picture with your phone, and that QR code will bring up a way to schedule an appointment, or you can just reach out to Jason and or myself at the information provided there. But again, this is just a jumping off point. Everybody's situation is going to be different. I cannot overemphasize how important not just the proper policy design is, but also the individual custom tailored planning and strategy that goes around it, particularly when we're talking about more complex deal structures like a large scale commercial real estate investment for a syndicator. But whether it's an individual policy, company owned policy, however it is, there's a way that we can make this work for your particular situation. And we just encourage you to reach out so we can have a personal conversation with you.
Yeah. And I think just to demonstrate the wide variety of conversations we have, we may have people we talk to that just have some credit card debt, and they want to start something like this just to recapture their debt. And then we have large examples like this where we're doing big deal real estate. And then we've got, I need to find a way to save for kids' college and implement that. I need to just have a alternative retirement plan because my qualified accounts aren't working out for me. Or there's so many different situations that this can apply. And really, again, back to infinite banking concept, it's controlling that banking function in our life. That's the big idea. And how do we do that through what's going on in our own lives? So anyway, reach out. We'll wrap this up. Reach out. Let's meet, talk, answer any questions you have, and see what we can do for you. Thanks for sticking with us through this webinar, and we'll look forward to talking to you guys soon.